Hello and good morning to those on the West Coast. Good afternoon to those on the East Coast. Today we're going to talk about loan programs. I'm sure you hear a lot about different loan programs that loan officers are talking about or that are getting promoted or that people have. And the different programs can get kind of confusing, okay? So let's talk about the top four programs that you mostly hear about. You have FHA, conventional, VA, and USDA. Those are the top four that mainly get spoken about, and that's what we're going to cover today. We're going to talk about what each program does, what each program can do, and who they're meant for. Because truly, how do you know if a program is meant for you? How do you know if you should be using that program to get a house? Most recently, Fannie Mae, which is conventional. Okay, so let's talk about that first. Let's talk about conventional first. Under conventional, you have Fannie Mae and Freddie Mac. They're the two largest GSEs, which is government-sponsored enterprise, that buy loans. So they're the ones that write the guideline for conventional loans, Fannie Mae and Freddie Mac. Okay, most recently, Fannie Mae has a guideline change to their credit score, which says that you don't need a credit score. So what that means is, let's say you're a person who bought a car years back, had some credit cards years back, started making some good money, started doing very good on paying their bills, paid off the cars, paid off the credit cards, paid off student loans. And since then, you've been making so much money that you've never needed to use credit to buy things. So let's say it's been 5, 6, 7 years since you've actually used your credit. Maybe not even that long, maybe 3 years. Because you don't have any current activity, you don't have a credit score. You don't have a bad score, you just don't have a score, okay? And in that scenario, you can get a loan using Fannie Mae, okay? And the Fannie Mae guideline is used to be 620. So 620 credit score to get a house using Fannie Mae, but now you don't need a score. So it's not meant for bad credit. It's meant for those that just don't have the credit, okay? Or used to have credit and now they don't have credit. Or maybe it's someone who's just graduated college and doesn't have credit. So it's meant for a lot of different people, but it doesn't mean that if you have bad credit. But I digress. Let's talk about the differences in loans. Okay, so conventional, Fannie Mae, Freddie Mac. The only difference in them is that credit score thing, but everything else is pretty much the same. So who is this meant for? This is meant for someone who has a long-term strategy, okay? So typically this person would want to go with conventional because if you're putting 20% down or more, you don't have mortgage insurance, okay? It is meant for the person that has a little bit stronger credit, okay? Now, I know I just spoke about the person that if doesn't have credit scores can still get a house. Yeah, that's a segmented, compartmentalized part of the guideline, but it is meant for the person that typically has better credit scores, that doesn't want mortgage insurance, and is probably going to be living in this house for a long time, possibly paying it off. Okay. That's not an absolute. So none of these are absolutes, guys. None of these are absolutes. This is just kind of an idea of that person, because mortgage insurance is an added premium every single month when you make your mortgage payment, when you put less than 20% down, okay? So you can put, on a conventional loan, you can put 19% down, 18, 17, 16, 15, 14, 10, 9, 8, 7, 6, 5, 4, all the way down to 3 if you're a first-time home buyer, percent down, okay? This is using the traditional loan, not any kind of piggyback program, not any kind of down payment assistance, just using this loan. You can go all the way down to 3% down for a first-time home buyer. And if you're not a first-time home buyer, you can go all the way down to 5% down. Guys, I'm going to put my phone number in the chat. So if you guys have any questions and you want to have a private conversation, go ahead and give me a call. I'm also going to let you guys know that this chat room, is for your questions and answers. So if you have questions, I will answer them. Just go ahead and put it in there, even if it's off topic. As long as it has to do with mortgages or something that I'm familiar with, I'll answer your question. So go ahead and light up that chat box. But back to conventional loans. So like I said, it's not meant for a specific person. It's meant for what makes the most sense. Okay. So if you have 20% down and you don't have the strongest credit, but you want conventional because you don't want mortgage insurance, you'll probably try that first. Okay. Does that mean that's where you're going to end up? No. But it does mean it's probably the best place for you to try because you don't want mortgage insurance, and that's the only way to go. Now, conventional can be used on regular homes, stick-built homes, communities. It can be used on manufactured homes. It can be used in condominiums. Now, there's only certain places that will not allow Fannie Mae. I'll give you an example. Let's talk about condominiums. Condo associations have to be approved for conventional. So a conventional Fannie Mae will only say, we will finance this house if this community meets these terms, which means they have to have the right amount of insurance. They need to have the right amount of occupancy, meaning those that live there versus those that rent, and a few other rules. So as long as you follow these rules, we will allow financing here. So Fannie Mae will do a loan here. Freddie Mac the same. Okay. So as long as they meet that criteria, if they don't meet that criteria, then you cannot do a Fannie Mae loan there or a Freddie Mac loan there because that community must meet that criteria. Kind of off topic because that's a rare situation. A lot of people still buy condos, but it's not as much as those that want to buy regular stick-built homes. So if you are one of those persons looking into a condo, we're going to need to have a conversation so I can walk you through this properly to make sure that when you do find a condo that you love, that you're able to get it. Okay. So that's Fannie Mae for the most part. Okay. So, conventional for the most part. Remember, the guideline is 620, but Fannie Mae just doesn't have that guideline anymore. Freddie Mac does. Okay. If you don't want mortgage insurance, you put in 20% down or more. You can go all the way down to 3% as a first-time home buyer, but you will have mortgage insurance. And you can go down to 5% if you're a repeat buyer, and you will have mortgage insurance. And here's another thing. As you put more money down, okay, here's your down payment. Here's your mortgage insurance. As you put more money down, your mortgage insurance premium is less per month, okay? Because the risk is less. So as you start doing this and you hit 20%, the risk goes all the way away and there's no mortgage insurance. So that's kind of a way to look at it. The less money you put down, the higher that mortgage insurance premium is going to be per month. And then the next question is, how much is that per month? Well, it depends on your credit, okay? Everything is driven by your credit. It's driven by the risk, just like your interest rate. The higher your credit score, the lower the mortgage insurance, the lower the interest rate. The lower your credit score, the higher the mortgage insurance, the higher the interest rate. So it's all based on risk. If you're a risky person, you pay more. If you're a less risky person, you pay less. And that's the benefit of being a less risky person. That's the benefit of managing your credit properly. There's pros and cons to this stuff, guys. So just know that. Now, let's talk about FHA, probably the most widely used program across the nation. Now, know this, guys. Our bank is licensed in all 50 states, so we do loans in a lot of different places. From Florida to California, from Washington to New York. So we cover a wide amount of states, and we've done business in a lot of them. Okay. But FHA is the most popularly used. And your question is probably why? Why FHA? Because it's probably the reason why is probably because they allow the credit score to go down to 580. Okay. So you can get an FHA loan with a 580 credit score. If you have a 580 credit score, you are not getting a conventional loan. Okay. Because a 580 means you've not paid some bills on time. It means you're not managing your credit well. It doesn't mean you don't have credit. It means you have crappy credit. And FHA will allow you to get a house with the credit score that low. Does it guarantee an approval? No, it doesn't guarantee an approval. It just means that you have an opportunity to see if you can get approved. So these guidelines, guys, that I'm referencing, these aren't absolutes. These are not situations that said, hey, you got a 580 credit score, you're approved. It does not mean that. It does not mean that. It's an overall profile. Remember, loans are based off of income, assets, and credit. We're just talking about the loan program right now, and we're just talking about pieces of it like credit score. So just because you have the credit, you may meet one of the three, but the other two must be strong. Okay, those are called compensating factors. So when you have one that's weak, the other two better be strong. Okay, if you have two that's weak, that one better be freaking monstrously strong. Okay, so for instance, you have a low credit score and not a whole lot of income. Well, if you have a whole lot of cash, that could save the day. Okay, if you have a low income but a high credit score, that can help you out a lot. Okay, if you have no assets but a high credit score and a high income, that could save the day again. So compensating factors, guys. If one of those is weak, one of the other two must be strong. If you have the other two is strong, you're probably off to the races. I digress. Once again, back to FHA. So FHA, the most widely used, the most easiest to get approved for. Okay, most easiest to get approved for. So if you have less than perfect credit, if you don't have that much cash in the bank, if you've never bought a house before, FHA is probably the route that you're going. Okay, even those that have bought a house before, but maybe have had some challenges on the credit and now they want to buy another house, it's common for them to use FHA again. Okay, especially, okay, here's a big one: mortgage insurance. So FHA has very reasonable mortgage insurance. They only ask for a minimum of 3.5% down. You are putting less than 20%. Okay. It's irrelevant with FHA, but I'm just giving you the example. Anytime you're putting less than 20%, remember you're going to have mortgage insurance. FHA is going to have mortgage insurance regardless of how much you put down. If you put 10% down, 20% down, 30% down, 90% down, you will have guaranteed mortgage insurance. It does not matter. And it is for the life of the loan, which means if you have that loan for 30 years, you are paying the mortgage insurance for 30 years. It never falls off. Conventional, let's touch on that for a second. Let's hop back. Let's say you put 5% down, which means you have a 95% LTV. And now you've paid the loan down to 78% LTV, which means you have 22% equity. At that point, mortgage insurance will fall off. Okay. If it takes you 10 years to get there, 20 years to get there, whatever, maybe you have a lump sum of cash that you got a windfall, maybe a bonus from work, and you were able to pay down your mortgage sooner. Once you hit that 78% loan to value, boom, mortgage insurance disappears. Not on FHA. Not on FHA. On FHA, it's for the life of the loan. Just want to round that home so you guys understand and you know. So once again, regardless of how much you put down, you have mortgage insurance. It is for the life of the loan. The one place where it does change is that once you hit 5% down, your mortgage insurance drops a little bit, but that's it. It's that one step down, and that's it. So putting more money down, it doesn't adjust your mortgage insurance. But that person who is applying for the FHA loan has a good chance of getting approved, providing they have a 580 or better credit score and providing they have 3.5% down for the down payment. Okay. FHA can be allowed on regular houses, condos, manufactured homes. So it's just the same as conventional. Also, one thing that I missed, conventional and FHA will allow you to buy up to a 4-unit property. So like a quadplex. So you got single, duplex, triplex, quadplex. Okay. So you can buy up to a 4-unit property, both on conventional, both on FHA. Okay. Still the same guidelines. 3.5% down for FHA, 5% down for conventional. Okay. Pros and cons to both. We'll run both scenarios to see what makes the most sense. Why would somebody do that? Well, let's talk about it. So if you buy a 4-unit property, you have to live in one of them, okay? But you can rent the other 3. And the other 3 that you're getting rent on, we can use to help you qualify for that 4-unit property. So typically more expensive than just a one house, right? So buying 4 units in California costs you $1 million easy. Okay. Buying a house in California, let's call it $500,000. Okay. So buying a house just to yourself is half the price of buying 4 units. So when you're buying 4 units, maybe you qualify for $500,000. Okay. So that $500,000 is covered. How do you cover the other $500,000? The 3 other rentals, the 3 other units that are being rented. That's how you cover it. You can use that future rental to qualify. Yay! Anyways, just want to let you know that you can do that FHA and conventional. So back to FHA. So FHA will allow you to get into any one of those different types of properties, basically any type of property. But once again, going back to condos, it must be FHA approved, the association, or else FHA is going to go, hey, they're not meeting the guidelines that we want to meet to be able to finance there. Can't do a loan there. Sorry. Have to think of a different route. Once again, if you're thinking about buying a condo, let's have this conversation so I can dial you in and make sure you're on the right path. Give me 1 second. Let me taste this. Okay. All right, guys, we're moving. So FHA, easier to get qualified for, less than perfect credit, less cash in the bank. Now, here is a strategy for you guys, for some that may not know. If you have less than perfect credit, let's say you have 550. That's not even less than perfect credit. That's bad credit. Okay. Let's say you have 550 credit score. You're like, I can't get FHA because they ask for a 580 credit score. You are correct. But if you have more to put down, you may qualify. One of the magic numbers is 10%. Okay. If you have 10% down or more, you might be able to go all the way down to a 500 credit score using FHA. Once again, FHA to save the day because less than perfect credit, still able to buy a house. I've done these for people. 520 credit scores, 530 credit scores. Putting 10% or more down per month helps. And there's not an absolute. Okay, guys? So just because you have 10% doesn't mean that you meet the guideline, okay? Doesn't mean that it's going to be approved. Every file is different. It's the overall profile. Remember, compensating factors. If you have weak credit, your income must be strong. Hopefully your assets are strong along with it. So after you put the 10% or more down, hopefully there's money left over for reserves. And let's talk about reserves. I keep this. See, this business takes us in so many different places all over the place. I hope you can stay with me. If you're not, give me a call. I'll have a conversation with you one-on-one. Name the numbers in the chat box right there. At least it's right there in my side. I don't know what it's like on your side. Okay, so back to there's no absolutes. So 10% down or more, maybe you get approved, maybe you won't. You got more assets, you have a better chance. Okay, so FHA, very flexible product. I love FHA. It's one of my favorites because it helps so many people. I love conventional too, and the other FHA and USDA, which we're going to touch on here in a second. But FHA has my heart. It really does. It's helped so many people. I've seen so many people, be able to go that route when the other routes weren't possible. And let's talk about a couple other routes, and then we'll come back and we'll touch here and there. Okay, so let's talk about VA. The VA loan is only meant for one special group of our country, and that is the United States Armed Forces, our military, the men and women who have put it all on the line for us to be able to have these lives right now and talk about whatever we want to talk about. And I mean, with the turmoil that's going on in the country right now, I'll tell you what, we are super blessed to be able to wake up in the morning and not hear bombs going off in the middle of the night. So that's pretty cool. So love this country. Now, the VA loan is meant for our military men and women. It can help for those that are currently serving. It can absolutely help those that have already served and have a honorable discharge on their DD 214. If you are not military, this is irrelevant to you. Maybe good for you to know, just because you have some data that a lot of other people don't know. But the VA loan, so what happens is there's a special little thing called a funding fee on a VA loan. Okay, that is basically insurance for all the VA loans. So because of that funding fee, which not every veteran has, if you are service connected, 10% or more, you will not have a funding fee. Okay. But for the rest of the people that have a funding fee, it helps insure all the loans. So that a VA loan, a veteran is able to get in on this loan with zero down. No special program, no piggyback, just using the VA, zero down. So they do not have to have that much money coming into this transaction. Okay, that's one of the biggest benefits to the VA loan. It is only for current military and veterans. Yes, it applies to all branches. Army, Navy, Marines, Coast Guard, all of them. Okay, it applies to all branches. The only qualifying factors are you must have served enough time. So if you're currently active, call us. Let's have this conversation so we can do our due diligence to see if you do qualify, and maybe you can buy a house while you're still in the military. Happens all the time. Done it for so many of our current military men and women. And then for the people that are honorably discharged, okay, you served. I don't care when you served, okay. We've put houses, men and women into houses from Vietnam. Doesn't matter when you served. Doesn't matter the time period. Doesn't matter if there was war or not. Could be peacetime. You could have done 4 years and nothing was going on in the country. All you did was your job in the military, exercised a whole lot, got out, and now this benefit is yours to use. So the VA loan is an amazing tool. I think it's something great that they've done for our country, for our men and women that have served or are currently serving. Okay. Another cool fact about this one is you're putting less than 20% down. So what should it technically have? Mortgage insurance. It does not. Stop that. VA loan does not have mortgage insurance. So you get zero down. You don't have mortgage insurance. Okay. It is a super easy loan to get approved for a vet as well. I would say probably as easy as it is to get approved for FHA. Okay. Remember, conventional is the hardest to get approved for unless you have a clean file or at least a pretty clean file. So VA is darn easy to get approved for. Okay. It does not go off of it is not income driven, I should say. Okay. It is not credit score driven necessarily. It is reserves driven. What does that mean? Okay. So the VA loan asks for a loan officer like me to do an extra step, which is a residual income on the backside, which means after you've paid all your debts, that's your auto payments, credit cards, student loans, personal loans, all that stuff. After you've paid your taxes, okay, there's a calculation that we do for your taxes. After everything is paid, how much money do you have left over is the biggest deal when it comes to the VA loan. And if you just meet the guideline and you have okay credit, you probably get approved. If you have a bunch of money left over and you have okay credit, you're going to get approved. So that's what I mean by residual driven. After everything's paid, after everything is dispersed, how much money do you have left over? That's the biggest deal when it comes to the VA loan. Once again, you can use the VA on any kind of house. You can use it on stick built. You can use it on manufactured. You can use it on condos. So it doesn't matter the type of home or property that you're purchasing. You can use the VA loan. I hope that helps. Let me see if there's anything else that I should touch on when it comes to the VA loan. Okay, so here's something really cool that just came out. Not just came out. It's probably like 5-6 years ago. But there's no longer loan limits on VA loans. What does that mean? What do you mean there's no loan limit? Okay, so let's touch on these. Every program has a loan limit. Conventional has a loan limit. FHA has a loan limit. And USDA has a loan limit. VA does not have a loan limit, which means they will let you borrow as much money as you can afford or that you want to buy a house. Okay, so just a number across the board. Number across the board for the most part is about $800,000. So whether you're buying in California or New York or Florida, in between, a good average number is 800,000. So once you hit 800,000, that's the most amount of money that you can borrow to buy a house before you break into another tier. So there's tiers to it. There's conforming, there's high balance, and then there's jumbo. Okay. At every tier, pricing changes, down payment changes. Most of the time, it becomes a little less attractive. Okay. So for the most part, you want to stay conforming so you get the best case scenario when it comes to the down payment and the interest rate. Once you break into high balance, you might need more money down. You might have a higher interest rate. And then you break into jumbo, you might need more money down. You might have a higher interest rate. So you want to stay conforming. Okay. That goes for conventional, FHA, VA, USDA, goes for all the programs. Okay. I don't want to get too far off on this, but I do want to share that with you. But here's what that means when it comes to VA. It doesn't have that problem. It literally just walks up as high as you want to go, above 800,000. If you want to hit $1 million, if you want to hit 2 million, if you want to hit 3 million, okay, you can absolutely do that. It's amazing. Okay, here's another one. So when it comes to military men and women who have already served, unfortunately, they don't all leave as well as when they first enlisted. Okay. Lots of things happen. It's the military. It's not an easy job. It can be a very difficult job for some. Some have risked it all. Some have lost a lot. Okay. Whether it's body, mind, soul, whatever it may be. And because of that, they may become medically retired. Okay. Which is called service connection disability, which is what I spoke about a second ago. When you hit 10%, you don't have that funding fee anymore. So that's one of the benefits for those that have gone further than others. They get that extra benefit. Now, they receive an income monthly. Okay, so if this is you, pay attention. If you receive that income monthly, that income is non-taxable. Non-taxable. Here is another way that I'm able to help with this loan, with that income, is I take that income and I can gross it up by 25%. Let me give you an example. Okay. So right now in 2026, if you're a person who is receiving service connection disability and is 100%, because there's scales, there's 10, 20, 30, 40, 50, all the way up to 100%. And the higher the percentage, the more income you make. Okay. But I want to give you just an example because it applies to everyone, but I want to make the math easy. So let's say you're 100% and you're making about $4,000 a month guaranteed, non-taxable. We're able to gross that up 25%, which means now you make $5,000 a month, okay? Because of the cost of living and because it's non-taxable, we can act like you're making 500, which means it'll make it easier for you to qualify because it looks like you make more money. Does that make sense? Also, for those that can afford it, it'll allow you to reach higher for a higher purchase price. Whether you're under the loan limit or not, it doesn't matter. So this is where I think the loan is brilliant. I think it's amazing. Okay. Let's touch on the last one really quick. USDA, which stands for the United States Department of Agriculture. What does that mean? It means it was originally meant for farmers. So farmers were able to take a loan, not pay a down payment. Okay. Once again, not pay a down payment. It is kind of a difficult loan to get approved for. I'll be honest with you. Probably the hardest of the four. And the reason why is because you have to have very tight ratios. It does go down to a 580 credit score, but for the most part, unless you're buying in a really, really rural area, it can be a little difficult to get approved for. But, let's give it a shot. Let's see if it makes sense. Now, like I said, it is meant for a rural area because it was specifically made for farmers. So what you do today is you go to USDA.gov, and there's a map. There's a map of the areas that are USDA approved, and you're allowed to do a loan in these areas. So you can't just do it just anywhere. Okay. So what I recommend is for those that are interested in the USDA loan, because it has no down payment. Okay. And you may be buying in a rural area, and rural doesn't necessarily mean you have to be in the middle of nowhere. Okay. It just means that it has to be a zone designated by the USDA Department of Agriculture, saying that, this is an acceptable place to do this loan. I know that, like, I'm in California, and up and down the 15 freeway from, let's call San Bernardino County all the way down to San Diego County, there's a whole lot of land along the freeway that's USDA approved. Okay. So that area, in my opinion, it's such high traffic. There's so many people going through there, any given day of the week. If you're on the weekend, expect to be parked in a few locations from here and there and on the way back. But it is zoned agricultural, so there may be an opportunity for you. But for USDA, the biggest benefit is that you can get in with zero down. You do have to be in a rural zone. So go to USDA.gov, put in your zip code. It will tell you, closest to this area, maybe the exact area, if you are approved for a USDA loan and if you can get in for zero down. Okay, guys? So once again, my number is in the chat box right there. At least on my screen, it's right there. So if you have any questions, comments, concerns about anything that we discussed today, if you're a first-time home buyer, move-up buyer, VA, non-VA, doesn't matter. Give me a call. Love to help you. Love to walk you through the process. If I get to meet you in person, awesome, because I don't get to meet a lot of our clients in person. But if not, we could do a Zoom just like this one, or we could do a phone call, whatever makes the most sense. But call me, text me, want to help you all. Hope you have a great Saturday. You guys take care. Have a great day. Bye-bye.